A tax year is your annual accounting period for reporting income and expenses. For individuals, it's basically always the calendar year, January 1st through December 31st. Businesses may have options, but the key exam move is this. Identify what the entity is, then match it to the allowed tax year. If it's not a full 12 months, your brain should immediately say short tax year. Calendar year is simple. 12 consecutive months ending December 31st. A fiscal year is also 12 consecutive months, but it ends on the last day of any month other than December. On the EA exam, they love wording tricks like ends November 30th or ends June 30th. If it ends on a month end that isn't December, that's a fiscal year. There's a weird cousin, the 52/53rds week tax year. It's still a fiscal year, but it's measured in weeks, not strict month ends. Businesses use it to end on a consistent day of the week, like the last Friday in June, or the Saturday closest to January 31st. It can be 52 or 53 weeks, so the ending date can shift year to year. Now the short tax year. That's any tax year under 12 months, and it usually happens for 3 reasons. 1, the entity starts up mid-year. 2, it terminates mid-year. 3, it changes its accounting period, like switching from fiscal to calendar or calendar to fiscal. On exam questions, if you see first return, final return, or changed year-end, think short year. How do you adopt a tax year? A business adopts its tax year by filing its first income tax return using that year. Calendar year is generally available to any business entity, but not every business can just pick any fiscal year. A new C corporation is the classic exception. It can generally elect whatever fiscal year it wants. That's a favorite EA exam contrast. Changing a tax year is not just do it next year. Typically, you request IRS approval by filing Form 1128, application to adopt, change, or retain a tax year. The exam angle is straightforward. If the question says the business wants to change its year-end, the form you're looking for is 1128, and a change often creates a short tax year in the transition. Which statement about the accrual method of accounting is not correct? One option says advance payments are generally income when received. Another says you report income when earned and deduct or capitalize expenses when incurred. Another mentions taking a deduction when economic performance occurs. And one option says you report income when received and deduct expenses when paid. Think about it. The incorrect statement is the one that says you generally report income when received and deduct expenses when paid. That's the cash method, not accrual. Under accrual, income is generally recognized when earned, and expenses are generally deductible when the all events test is met and economic performance occurs. The tempting trap is mixing received and paid language into accrual. Cedar Valley Foods is a fiscal year C corporation using the accrual method. What's required for the company to deduct an expense? Some choices focus on paying before year-end, paying first, receiving an invoice, or meeting the all events test plus economic performance. Which requirement actually controls for accrual basis deductions? Think about it. The correct answer is that the company must meet the all events test and have economic performance to deduct the expense. Payment isn't automatically required under accrual, and simply receiving a bill or invoice doesn't control the deduction either. A very tempting wrong answer is they must receive an invoice, because it feels like proof, but it's not the legal timing rule.